Welcome back to Focus on the Future. For the past several weeks, we have urged you to form financial relationships, especially in three core areas: banking, insurance, and investing. You might be questioning the value of making the effort to do so. Today, we're going to take a closer look at the value of establishing a banking relationship through lending, which it turns out is a financial institution's main function and profit center. At some time in your financial future, you'll find yourself in a position where a loan will solve or mitigate a financial problem. It might be an investment opportunity or a financial emergency. Either way, you'll be well covered if you've established a personal financial relationship with your financial institution. If not, you could be looking to payday or title loan lenders to solve your problem, which could turn into a financial nightmare. Our guest today is Michael Altamirano, a lending professional with BBVA Compass Bank. Welcome to Focus on the Future, Michael.
Thank you for having me.
Good to see you.
Appreciate it.
First question, and it's just simple. Am I correct that the main profit center of most financial institutions is lending?
You would be correct in saying that. Lending is a big revenue booster for all the financial institutions. That's where we make most of our profit.
Mm-hmm. I can imagine that banking legislation over the past 3 or 4 years has kind of changed the face of banking a little bit, especially the Dodd-Frank Act, making it a bit more difficult perhaps to lend from a credit standpoint as well as generate fees. True?
That's very true. The Act has limited banks on offering free products and things like that, because we have to keep up, of course. We're in the business of making money.
Right. You guys aren't social workers.
Exactly.
We know that, yeah.
And it's, we're real limited now on credit standards, as far as minimum credit guidelines on lending money. We've really tightened the belt, made it really strict, and, a little harder to come in and get that personal loan.
Yeah, yeah. I can imagine it is. We're going to get into that a little bit. Do you think, or actually, I know that you do think this, that a banking relationship is important, but relative to lending, why is it so important to have a banking relationship?
Well, especially now, and as you mentioned, due to the legislative acts that have been passed, it's very important. That relationship is going to separate you from someone that just walks in off the street. We're going to be able to offer you a little more incentive, maybe work with you a little bit better because of that relationship that you've built over time.
What do you suppose the most typical loan is, Michael, in terms of the types of loans that people walk in off the street and actually want?
In my experience, it's the personal loan.
Personal loan.
We have that individual come in and say, I just need to borrow a couple $1,000s, need to catch up on some bills, pretty much just trying to catch up. And they're just walking in saying, I need this for maybe 6 months and I'll pay that back. I would say that's the most popular loan that people ask for. So
they're using it for, when you say a personal loan, they could be using it for anything.
They can use it for anything. But from what I've seen, especially in today's economy, a lot of it has been to catch up on, past due bills. But of course, it can be used for a number of things, maybe a car repair, water heater goes out, they need to fix that. So it's a good short-term way to take care of something like that.
Well, that makes a lot of sense to me. Now, in terms of the process of this loan application, kind of walk me through it a little bit, can you please?
Yeah, well, the loan application right now, the main thing right now that we're looking for is credit score.
Okay.
We have a minimum guideline of 640 right now. Used to be a lot lower. We used to be able to kind of work if maybe you were 615, had that relationship. Now 640 minimum. Anything below that,
Going to be really tough.
it's tough. It's
Almost impossible.
almost impossible. And the other thing, of course, is income. We need that form of income. Show that you have a steady job, you're earning that income, you can afford to pay those, the monthly payments.
Right.
And of course, the debt to income ratio is another big thing that we look for on the application.
What is the debt to income ratio?
Well, debt to income ratio is basically how much, based on your income, and how much of that income monthly goes towards debt. Right now, we can do below 45% on our debt to income. So in simplest terms, 45% or less of your income can be going to outstanding debt, whether that be credit cards, mortgage, any type of loan.
Now, your loan can't take me over that threshold. Is that what you're telling me?
It cannot.
So including the loan I'm going to make from you, that 45% is the bottom line.
Bottom line.
Okay.
So we're going to add our payment in
Right.
to that percentage as a new form of debt.
Okay.
And we have to keep you below that.
What are the minimums and maximums on personal loans like this, Michael?
Well, before, of course, before legislature and in Congress passing these new acts,
Right.
we used to be able to do a quick personal loan. You walk in, $500, you're out the door. Now, we have a $3,000 minimum. Minimum.
Okay.
So, for that customer that may come in and say, payday's in a couple weeks, I need to catch up on some bills, I just need $500, we can't really cater to that anymore due to the new credit guidelines. And of course, the bank being in the business of having to make a profit.
Right. And on a $500 loan, you don't feel like that you can make a profit on that?
Exactly.
Where do these people go that need $500?
It's unfortunate, but most of them will end up going to a payday or a title loan or,
Oh my gosh.
one of those, shops there on the corner of the street that has a big neon sign saying, "Come on in,
Right.
we'll lend you money."
Yeah, cash right away, right?
Yeah.
Need $1,500? No problem.
Exactly.
The problem is the interest rate on those loans, right?
You're right.
Yeah, in fact, Emily and I have studied that particular industry a lot. And we find that the typical interest rate on a payday loan is 385%.
Wow.
That's a bit steep, don't you think?
Very steep.
I kind of think so. Now that we've talked about that, what kind of interest rate are people walking in BBVA looking at?
Well, right now we have our personal loan, again with that minimum of $3,000.
Right.
You're looking at about a 16 to 17%. And that's going to, of course, be dependent on credit guidelines.
Okay.
And then going back to that relationship that we talked about, we can do certain discounts if you have a relationship with us.
Oh, really?
And have automatic payments set up. We can give you a 1% discount to help you out on that.
So instead of 16, I'd be paying 15?
We can do that, yes.
That would be very nice because that 1 point makes a difference. doesn't it?
Exactly, it does.
Now, these loans are installment loans, correct?
That's correct.
All right. Kind of walk me through what is an installment loan? How does that work?
Well, an installment loan is basically an agreement that you make with the lender that you agree to pay back a certain amount over a certain course of time. So an example would be you borrow that $3,000 loan on a 12-month note. You promise to pay back a certain amount each month in order to pay that back, plus the interest that we're charging you.
Okay, gotcha. Let's take just a little scenario, if you will, and let's talk about two theoretical customers.
Okay.
Both of them have a credit score of 635. Now, I realize you said the minimum is 640.
Correct.
But both these people walk into your office. One, you know very well, has had a relationship with your institution for, let's say, 10 years. Has an account here, has direct deposits here. You know that person by their first name. Heck, you probably even know their family, right?
Right.
The other person you've never seen before. 635.
Okay.
What happens? Can either one of those people get a loan?
I can tell you the guy off the street is going to come in, 635. Our computer is going to decline them immediately. We're not even going to go to an underwriter to review that.
Can't
It's
even
an
be
automatic.
There's nothing to talk about.
Automatic.
Okay.
Now that relationship, that person that's been with the bank, several years,
Right.
we know each other.
Right.
We may be able to help that person. It's not 100% guarantee, but by having that relationship, it gives them an advantage over the person off the street, where we can go, me personally, to the underwriter and say, here's the situation. I vouch for them. They've been a customer for so many years. They've had 2 loans in the past paid off. They're caught up on all their bills. Maybe their credit went down for a certain reason, whatever that may be. But that person's going to have a big advantage, and it all comes down to that relationship.
So you think maybe the odds are 50-50 or even a little bit better than that at that 635?
I would say 50-50 is good.
Okay.
And again, the big thing too is I have to build relationships with my underwriters as well. And that's a big, thing that helps as well.
Now that's something interesting. So you're talking about you have a relationship with the underwriters.
Correct.
So they know you, and they know that when you recommend someone that you're not going to do so based on flim-flam stuff.
Exactly. So by me, working with them in the past and building that relationship, they can trust my recommendation that I'm not just doing it to get this loan approved and signed and out the door.
Right.
I'm doing it because I'm truly vouching for that customer
Right.
and their relationship.
Now, you had a recent situation that's kind of like this, I think, where somebody walked in and they were behind on their bills and you were able to help them a little bit. Tell us a little bit about that story.
I had a customer and they were a little bit behind on bills, a couple months, so it wasn't too bad. Their credit score kind of had dwindled down. Luckily, we were just below the minimum of that 640. Mm-hmm. And because of that relationship that they had with us, the relationship I had with my underwriter, we were able to work a deal where what we did was we consolidated all of their debts, paid them off, and we provided that service of sending those payments.
Oh, you did?
We did that for them.
The bank actually did that?
Correct. And
Terrific.
that was part of the stipulation,
I see.
We wanted to make sure that, yes, we are paying these off.
Okay.
So it was our responsibility to do that. And the customer had one payment. We were able to save them close to $400 a month.
Oh my gosh, that's significant.
And so, that's a situation, I wish it was more often that we could do that. But it just so happened that in this case, we were able to get that approved.
And that seems to me to be a pretty good reason to borrow money. I mean, we try and recommend to people, don't go into debt unless you absolutely have to. And look at the kind of debt you're going into. Maybe a student loan, okay, if you're furthering your education. But if you're going into debt to buy a Blu-ray player, really? How much sense does that make, right?
Exactly.
So this kind of debt, I think, to pay off other loans that perhaps are old and high interest rates, and now you can lower your monthly payment by $400.
Exactly. That's to me, that's a loan that is well needed, and it's going to serve them, great benefit in the long run because they're able to save that extra money, put towards saving, especially in this economy. That every little penny counts. Boy,
you're absolutely right about that. Now, these installment loans, these personal loans, don't require collateral, correct?
They do not.
Okay. What kind of a loan? First of all, I guess we should define what the heck is collateral.
Well, collateral is basically you're putting something up to back the loan.
Is it like a pawn shop deal?
Well, I mean, you could compare it. I mean, you're not going to come and give us a gold ring and we're going to say, okay, we'll appraise this gold ring. But I mean, it's similar. The collateral that we're going to accept is a vehicle.
Okay.
You have a paid off vehicle.
Right.
It meets our guidelines. We're going to use that as collateral. So if the note is not paid, or you fail to pay off, the remainder of the loan, then we have that vehicle there to go ahead and sell and pay ourselves back for what you were unable to pay.
So I imagine that if I'm using a vehicle, I mean, that's a depreciating asset, right?
That's correct.
So if I'm using a vehicle, you're going to give me a pretty low ball figure on that.
Correct.
Collateral-wise.
Exactly. And that's the thing, we get a lot of customers, especially with those loans, they'll come in and say, well, this is what my vehicle's worth. But of course, we use our own system. It's called Black Book.
Right.
And we use that as a more conservative figure because of that depreciation.
You would absolutely have to do that.
We need to make sure that if you don't pay that we're going to get our money back.
Is that the most typical type of collateral that's offered up on a loan, or do you see other things?
I mean, I would say that's the most common.
Okay.
But we do offer other ones. You can use your home as collateral, or investments. Stocks and bonds and things like that. You can use as collateral.
401ks?
As well. 401k, no.
No.
We don't offer that. But we do, if you have an individual, investment account for retirement, we do accept that.
I gotcha. So real estate, automobiles, investment accounts, that's the typical type of collateral?
The typical type. Even CDs, we can do a CD secured loan.
Okay.
So those, but I would say the auto is the most typical.
All right.
And they would, I guess you could consider that also a title loan as well, coming in with the title to that vehicle.
I guess you could, but you're not going to be charging me 385%.
Exactly, we're not.
Okay. The interest rates are comparable on a collateralized loan to this 16%, or are they lower?
They're actually a lot lower. That auto loan, you're looking at maybe anywhere from 6 to 9%. So it's a lot lower.
Yeah.
And the reason we can do that is because we're taking a little less risk, knowing that we have a way to reimburse ourselves if you
Now, are all collateralized loans, are they installment loans, or can some of them be balloon payment loans?
Well, we've pretty much gotten out of the business of doing those balloon payment options. So most of our collateralized loans are going to be an installment with a fixed payment.
Same type of deal.
Same type of deal. We do offer our, again, going to our home equity, meaning you're borrowing on equity on your home.
Right.
We do offer a variable rate where you're paying interest only, and then at a certain period of time you can pay it all off.
I gotcha.
But we really have gotten out of doing those balloon payment options where you walk in, borrow $1,000, and promise to pay it back in a month.
Right.
Plus that interest. We've really gotten
because
away
that,
from that.
Yeah, and the people that have filled that void, unfortunately, are the payday lenders and the title loan lenders.
Exactly.
Because if I need to borrow $1,000, I can't come in here and do that anymore.
You can't.
So I'm left with some interesting choices.
Exactly.
I can go to a second-tier lender, maybe.
Correct.
Or I can go to the payday title loan folks, definitely, if I'm willing to pay 385% interest.
Exactly.
Quickly, because we're just about out of time, what would you advise young people to do if they want to borrow, let's say $1,500? Where would you advise them to go to get away from the payday lenders?
Well, what I would suggest for that amount, a lot of what we see nowadays are college credit cards, which you have to be responsible with that.
Oh, yes.
If you're going to do it. You've seen a lot of kids get into trouble with that. The best recommendation, being 18 years old, no credit, working with your parents or a guardian to maybe co-sign on a personal loan. Maybe you're looking for that vehicle for college.
Right.
Have your parents put your name on that.
Right.
Be a part of that so that you can start establishing that credit history. Or again, that college credit card. But with that, my recommendation is to make sure that you know someone either that you're dealing with at your financial institution that's going to be able to monitor that with you. Make sure you understand the real way that it works.
So it still comes back to that banking relationship, which is so darn important.
Exactly.
I think we've established that.
Exactly.
Michael,
make sure you do it with someone you know.
Makes sense. Thanks for being with us today, bud.
Thank you. Appreciate
it very much.
Thank you.
I thought that was a great interview. What did you get from it?
Well, Michael had a lot of great information for us, and some things I knew and some things I didn't know. Of course, we always tout having a financial relationship. You're probably going to need a loan at some point, and it makes sense to know a banker or know a bank where you can actually get that loan.
Well, if you don't have that kind of thing going for you, it's pretty obvious that if your credit score is iffy, you're walking out the door.
And of course, you have to guard that credit score because that's a factor determining whether or not you're going to get the loan.
Indeed. Something else I thought was really interesting was the fact that he said that he has a relationship with his loan underwriters. That's interesting, don't you think?
Hadn't thought about that before, but it makes sense. He has to have a relationship too.
He does, and think about this. If you're dealing with a lender that's been in the business a week, 2 weeks, probably he hadn't had a chance to establish a relationship with his underwriters.
It would make sense to go to a lender who probably has been at the bank or the financial institution a little bit longer.
I think that's a question you better ask.
Yeah, and he also mentioned something about your debt to income ratio.
That was interesting.
Makes a lot of sense. We don't think about things like that, but you have to add up how much do you currently have in debt, whether it's your car, whether it's your home, whether it's college loans.
And it's a pretty good rule of thumb. If you go over 45%, you're probably making a terrible mistake.
That kind of scares me, just thinking about 40% of debt.
Yeah,
That's a whole lot of money.
And the worst mistake I think you can make is to, again, think oh my gosh, I've got to go to a payday or a title lender.
Yeah, you have to go to a reputable lender.
Oh my
Someone
gosh.
like BBVA.
You just, folks, cannot pay 385%. Think about it.
Why would you do that when you can get a loan for 16%?
Makes no sense at all. Tell me what's next.
Next, we have Budget Busters, followed by the Stock Market Corner.
We'll see you all later.
Thanks. Hi, welcome back. Before we get into this week's topic, I've got a little bit of unfinished business from last week. Remember the tip about paying cash for your gas? Well, I got a question from one of our viewers. What if I use a debit card? Isn't that the same as paying cash? The answer is rather complicated, but suffice it to say no. When you use your debit card at the gas station and charge gas at the pump, the station has no way of knowing how much you're going to put into your tank. So with that in mind, they authorize a charge of, say, $100, even if you're only going to put in $30. Not a problem, you say? It could be, because that $70 difference could be out of your account for 3 to 4 days if the station doesn't transmit or batch their charges daily. That difference could overdraw your account and cost you hundreds in overdraft fees. There is a solution, however. If you're going to use a debit card when you pay at the pump, pay inside and specify an amount that you want to pay with your debit card. This will obviate, yeah, that's a big word, the station from authorizing more than the actual charge. And by the way, if you have a question for me, feel free to email me at emily@focusonthefuture.tv. Okay, now back to this week's topic. Do you recall your mom and dad yelling at you for leaving the lights on or the front door wide open? I used to turn the thermostat up to 80 degrees in the middle of winter when I was getting ready for school, and I thought my dad was going to have a heart attack. Well, the reason parents freak out is because they pay for the electricity, gas, and the water. No wonder my mom would tell me to keep those showers under 30 minutes. Those 3 budget items are considered utilities, and they are variable expenses, and today I'm going to give you tips on how to keep them under control. So, how much of your budget should go to the utilities? Most of us don't live in places where the utilities are included, so we pay for what we use. The short answer is it depends on how big the place is that you're trying to heat and cool, your use of electronics, appliances, watering plants, grass, the length of your showers. You'll have to calculate an average of your monthly utility expense before you get a very firm figure for your budget. In the meantime, be smart about this. You can put an extra blanket or comforter on the bed and turn down the thermostat at night during the wintertime. In the warmer months, open those windows and get a fan for some fresh air. You could convert the landscaping at your house to be a little more eco-friendly and turn off the lights when you leave a room. Check and double check to make sure electronics are turned off after use. Buy energy-efficient light bulbs and appliances. Turn off your computer and printer at night. I guarantee that these tips will lead you to lower and more manageable utility bills. See you soon. Hi, welcome back to the Stock Market Corner. I'm Emily New.
And I'm Tom Crow.
How are you today, Tom?
Very well. How are you?
I'm doing good. It's exciting. Christmas is coming. The market's doing better. We've got a lot of stuff to talk about today.
We do.
Yeah, what do you think is going on? What's happening with Europe? What's happening here locally?
Well, Europe is still an interesting story because while things look better over there, I think what Congress has decided to do in conjunction with the IMF and several other countries, the International Monetary Fund, sorry, I don't want to throw too much jargon at you all at once here, they've decided to make it easier for European countries to borrow. And we talked about this a little bit beforehand. The question is, where's it all coming from? Everybody's broke, everybody's borrowing money, and we're just going to continue to borrow more and more to prop up these economies. So
where are they borrowing it from?
They're borrowing it from investors. Basically, they're selling bonds. And unfortunately, what that means, like we just had the debt ceiling debate a few months ago, all these countries now that are right up against their debt limits are agreeing to raise their debt limits
in order
to print more money
for all of this.
So, you sell the bonds, that means you've got more money to spend. And they're just going to go further and further into debt. And it's this, like I said, it's this economic philosophy that you can just keep printing money and just pushing off the inevitable due date further and further down the road.
So it's really not solving anything, it's procrastinating everything.
It's a Band-Aid, and it's really starting to wear out, unfortunately. And I think, for our viewing audience at your age, you really need to start looking very hard at what's going on out here in terms of what the elected representatives are doing to your future right now. We've obviously got a bunch there. The super committee negotiations fell apart. They've obviously decided they're not going to do anything about this problem. They're just going to keep pushing it on and on. Every 2 years we're going to go through an election cycle and we're going to kick it further down the road. So what it means is that you're right now facing a standard of living that's lower than ours, and that to me is very disappointing. I think we should be more responsible, and like I said, it's disappointing to me to think that we've decided we're not going to make the tough decisions and we're going to push them on to your generation and even your kids and grandkids.
Yeah, well, what would you say to folks that are here that maybe have some investments that are overseas, and should we be looking at if those investments have any tie into some of these European countries, and if so, should we consider getting out of those investments?
Well, it all falls back on the banks and the banks' exposure to foreign markets. And we saw when we were worried about the foreign banks that our Citigroups and Bank of America, JP Morgan, stocks took a hit. Now the credit rating agencies have decided to tighten up the way they're going to analyze them, and they've all taken a hit in their credit rating, which means they're going to have to pay more to borrow more money to continue operations.
Right.
It's that same, we saw it happen in the countries in Europe, now it's going to happen to the banks. And it's this
Vicious
continuing,
cycle.
we're kind of circling the drain here, and debt's just dragging everybody down. And I mean, your budget segments and everything is all about responsible use of debt, not using it when you can't afford it. Right. But we got world leaders and corporate leaders that aren't getting the message, and they just continue to go further and further into the hole.
There's a bit of a disconnect. They tell the average citizen to tighten up on their expenses and try to be responsible, yet they're out doing the exact opposite.
Exactly.
Yeah. Well, what about the news that came out in terms of job numbers and unemployment?
Job numbers were okay. I mean, it was kind of a big nothing. We've said before, we need more than 150,000 jobs created a month just to keep up with regular population growth.
Right.
We created 140, government lost 20. So we had a net of 120. We had big upward revisions in the 2 prior months, which meant that our unemployment rate, which isn't revised when you go back, fell from 9 to 8.6. So that's a that's a big drop.
Right.
But it's because we revised the employment numbers going back, but we don't change the unemployment number as we look back at the same time.
So is that a solid figure? I mean, how accurate is that 8? It's kind of
fluid.
Yeah.
And we also talk about the way it's calculated, that's been changed multiple times over the years.
Right, so what's the constant?
There's an index called the misery index, which is unemployment and inflation. And it's where it was in 1983, but if we calculated it the way we did in 1983, we'd be in a much worse shape now, because we keep changing the way we calculate it to make things look better.
Yeah, so these numbers are almost meant to give a false sense of security.
They do,
yeah.
and to make the politicians look better, unfortunately.
And do you think that these figures have affected the number of the market recently? Because we've been seeing it going up this week.
Markets seem pretty happy with the numbers today. The other reason the unemployment rate dropped so much was because we had 315,000 people just drop out of the workforce entirely.
They just quit.
So they talk about jobs gained, jobs lost. We still have 6 million fewer jobs than we did this time in 2007. Wow. Yeah, we've created 3 million jobs since then, but we're still 6 million in the hole. So that just kind of tells you just how bad this great recession we are kind of on our way out of. 120,000 a month is not going to get us out of the picture. We need to be at about 250,000 a month for several years to get the real unemployment rate back down to in the 5 to 6 range, and also to get the number of unemployed people back down to a reasonable number. Right now we've had so many that have run out of benefits and given up looking for work that number of people that just aren't working is getting to be a problem. It's a big number, and there's a lot of folks that need some means of support.
And as all of this is happening with the politicians, I've heard some people hearkening back to the days of Ronald Reagan when jobs were being created about like 1 million jobs a month. I mean, they were just seeing the economy just skyrocket.
We were on a tear. I mean, basically, the things were just growing like crazy.
Well, what about some of these terms I've heard people talking about, short and long in the market? What exactly does that mean?
Towards the end of last week, we had a really nice run up. I think almost 500-point day in the Dow. It was a big day. What it did was get the month of November just about back to where it started. We ended up just a little under, so we ended up making up for all the losses we took. We were down 7.5% with just about 3 days to go in the month. And it all came back the last few days. But what I think that was, and what a lot of analysts think that was a short covering rally. Okay, so there's long and short in the market. When you're long, you buy a stock and you hold it because you think it's going to go up.
So it's kind of like a long-term hold of the stock?
It's just it's really has nothing to do with long-term or short-term. It just means you own a stock because you think it's going to go up.
Okay.
When you're short, you think the stock is going to go down, so you borrow stock from somebody, sell it with the intent of buying it back at a lower price later. So there's 2 ways to make money. You talk about bulls make money, bears make money, pigs get slaughtered. It's the people that know how to play the market.
Right.
If you think the market's going up, you go long the market because you're going to own those stocks as they're increasing in value. If you think the market's going down, you grab a bunch of stock, sell it, because the market's going to take everything down. You're going to buy it back later and give it back to that person. So they end up with no net difference. They still have the stock, but you got to keep the difference in the spread of what you sold it versus what you bought it back for.
There's so many little complexities and ways to work the market, and there's always
Lots of
something
moving
new to
parts.
learn.
There's always something new. That's right.
Well, what about our virtual portfolio? Can you give us some information
Our
on
little
that?
portfolio is not doing too well.
Yeah.
We took a week off for the break, and also, of course, the market around Thanksgiving, because there's a couple of half days in there and it's very low volume, tends to be very volatile.
And what about the whole Black Friday thing? Do you think that helped us with the
Black Friday
numbers
looks,
going up?
those numbers look good.
Okay.
I think the retail sales are coming on pretty strong, and I think due to short covering, due to the fact that about 80% of active fund managers, and I'm kind of one of these active managers types, about 80% of us are underperforming our benchmark. So we've got a month to make everything well. So there's going to be a lot of activity in the markets while these guys try and clean up their balance sheets and make their funds look good for the end of the year.
And not only that, everybody's out spending money for Christmas and stuff.
Everybody's spending, and consumer confidence is up a little bit, and with the unemployment kind of eking its way back up. It says we're in a deep hole, we're getting out, but we're just getting out very slowly. So we're not going to see the kind of takeoff changes anyway, at least not yet,
Right.
to where we see the economy really take off.
Right, and I've heard that some of the consumers are starting to use their credit cards more now with this holiday season, whereas previously they had just been using debit when they were at the terminal to punch out.
Right. Now, last week we got stopped out of our little steel company, unfortunately. We lost that one. And I started keeping track of a little bit more of the long term. So now we're down to 3 stocks because in the meantime I haven't found anything new to buy. Some of the buy signals I'm getting are just not that exciting. So,
but you know what? I think that's a great point. I think sometimes when we're active investors or buyers in the market, we think, well, I've got to get out of this one and get into another one right away. But I think it's important that you take your time, do the research, find something that you are very confident in before you invest that money.
Cash is an investment. So right now we're down to Bed Bath & Beyond, Cisco, and Kohl's. Bed Bath & Beyond and Kohl's should do pretty well this retail season.
Yeah.
If the market takes off, Cisco's going to do well just because it's such a big bellwether technology company. But even there, our gains are down to only about 3% on average.
Okay.
And
but we're still doing more than a savings account.
We're still doing better than a savings account. That's right.
Yeah. Well, I'm hoping that by the time we come back after the Christmas break, the news will be a little bit better.
We will hope so.
Yeah. Well, thank you guys so much for watching this semester. We've got to wrap up. We'll see you next semester. Thanks for watching, and a special thanks to Dillard's, the very special ladies there, Mona and Lulu, who have provided my wardrobe. Thank you guys. Have a good break.
See you next time.
And now this week's questions for classroom discussion. Number 1, what is the minimum credit score you must have to secure a bank loan? Number 2, how can you avoid a gas retailer from putting a hold on money in your checking account? And finally, what is threatening your future standard of living?